Let's focus now on Deere, a classic cyclical stock, one you tend to buy if you feel that farmers will be doing well. We've seen that stock moving up about 5%, and it's rallied almost 30% in the past year. Deere beat earnings estimates. It produced net income of $1.8 billion for the second quarter. Let's get more from Michael Shlisky, analyst and managing director at DA Davidson. Thanks very much indeed for joining us, Michael. What jumped out for you with these Deere results?
Yes, hi, Andrew. Several things jumped out for us. First of all, Deere did mention some bottoming commentary during parts of its comments, particularly in South America as well as in Europe. And so there are some that actually had the word green shoots for Europe, which is interesting. Some of it is due to some solid dairy price outlook and things of that nature. Even in North America, Deere mentioned that their inventories, which have been a challenge for a year or two now at the channel level, have more normalized, and they're able to start building the number of tractors that they build in line with retail demand. So it does sound like while there are some very near-term tariff impacts, it's only going to be about $250 million. The actual crop situation is not as bad as I think a lot of people were realizing.
Can you give us a ballpark estimate? How much of Deere's business is agriculture and how much is construction and other applications, even roughly?
Yeah, it's over 3/4 of the business is in the ag sector, which with over 3/4 of that is heavy ag, things that do wheat, corn, and soybeans. As far as earnings are concerned, even 80% plus would be on the ag side, with the rest of it being construction.
And is the crucial, maybe you can put up a 5-year chart for corn and another for soybeans. I mean, does Deere, because a global player, I know, but would it be fair to say that when corn prices do well, Deere tends to do well?
Yes, if you look historically at the price of Deere stock and the price of corn, sure, there is a rough correlation between the two. Sometimes Deere, there's obviously some ups and downs, but typically Deere has done well whenever farmers do well, especially when corn is above $4 or $4.10 or so, which it is currently. The stock has done well. That's the price that is the break even for a lot of farmers in the United States.
Is there anything, though, investors, I mean, you do call the stock a buy, you like the look of it, you touched on a couple of the reasons. Is there anything, though, investors should be wary of with Deere, perhaps a thing that could emerge that would be a reason to sell?
There was one thing on the call that kind of stood out to me on that topic, Andrew, and that is on pricing. Mm-hmm. They are facing inflation. There's inflation in general, there's tariffs in general that are certainly impacting their costs. At the same time, they mentioned they're going to take a very measured approach on how they pass it along in pricing to farmers. They've already raised prices so much over the past few years due to inflation, and farmers have had a rough couple of years. And that's actually a global comment. It's been tough for almost everybody. So it's hard to ask for additional price when you've got farmers that are already being stretched pretty thin. The hope is that they'll find a balance and be able to pass along most of the costs from tariff and from inflation on, but that is going to be a bit of a tougher challenge in the rest of this year into 2026.
Deere, as you know, has faced some heat over the difficulty of repairing equipment. Now, it's not unique to Deere. Lots of companies put out stuff that's very hard to fix. But farmers reportedly have been frustrated. They want to fix stuff quickly in the field. They got to work rapidly to get the crop in, for example. But sometimes they can't fix it. They have to call the dealer. It involves delay and expense. Now, Deere has addressed some of that criticism. But could there be a hangover here if legislators, for example, act?
Potentially, that could possibly happen. A lot of that happens at the dealership level, though. The dealers, and we heard about this on the earnings call that just ended. They are trying to invest in more tech support. Some of these tractors are so complex that they are not the tractors that their grandfathers used. Right. A lot of things involving cloud infrastructure and so forth. It does take a tech, and dealerships are apparently investing in additional tech support. And a lot of the things that can go wrong on a tractor these days can sometimes be fixed with a very simple software issue, and not having to go out there and get some duct tape or what have you to kind of fix something in the field. But it will take dealerships investment, not just Deere's investment, to get farmers to be able to fix their machines quickly going forward.
And we should know, maybe we can put up a 10-year chart for Deere. It really has delivered for investors. I mean, the stock in record territory today. What have they done right, would you say, over the past decade?
I think a lot of it, Andrew, is cost management. A couple of years ago, you see them, their earnings going up or down substantially with the cycle. It was taking a lot of cost out of the business and introduced a lot of flexibility on the supply chain and on how they build these tractors and combines, and that's really showed up in their results. Their mid-cycle operating margin is just north of 20%. Even here in a very tough market this past quarter, they put up nearly 19% operating margins, and that's for a company that's in a very tough spot. That's one of the best we've seen in ag and in industrials broadly. They've just done a great job executing on their cost structure and what they can control.
We'd better jump. Thank you very much indeed for joining us, Michael.
Thank you.
Michael Shlisky, analyst and managing director at D.A. Davidson. Fascinating to see Deere in record territory right now. Coming up,